A lot of decline, certainly. But when you got rid of that 15-year period and you get beyond it, there's a whole bunch more, the impact of that one period has less on the total number there. So it was a 10.7, but here's the interesting thing. You might wish that you had a little bit better worst case scenario, but I want you to look. The best 15-year period for the S&P 500 was a compound rate of return of 18.9. The worst was 0.6%. So after you got out there 15 years, you always made something. Not much, but something. And you're going to see it even gets better when you go out longer periods of time. You'll notice with the large cap value that the compound rate of return instead of 11 is 12.7. Whoa. And the best 15-year, 21.7. The worst was actually a 0.6% a year loss over 15 years. That's a substantial loss. And when you get to the small cap, the more risky small cap companies, the average was 13.4, and the best was 23.2, and the worst was a gain of 1.6. And then finally, small cap value. The best was 26.5. What a 5-year period that was. I mean, think about how you felt about investing if that happened to be the first 5 years as an investor. You would think, as my wife thought, when after a couple of golf lessons, the instructor took us out on a couple of holes over in Lanai in Hawaii, and on the second hole, she parted. Her second hole. And she had to go over a ravine to get there, as I, of course, was able to put 3 or 4 balls probably down the ravine. She thought playing golf was really easy. She found out otherwise later on. But it's the same thing. When you have the first 5 years be runaway returns like that, your commitment to the long term is much better than if for the first, 15 years, if for the first 15 years, it's up 1.6% a year. Those early years have a huge impact on people's belief and trust for the future and willingness to take the risk and kind of ride the wild waves of volatility that investing tends to produce. Now, it even gets a little better, 26.5 for small cap value, for the best 15, a minus 1.9, so the worst of the 4. Notice the compound rate of return was 15.5. I do not believe that you are going to get a 15.5% compound rate of return. Now, I have specifically ignored the stuff over here to the right, but I'm about to start paying attention to them in just a minute. Because I don't care what, if you're 10 years away from retirement, you likely, and you're going to have 30 years in retirement, a lot of people do, you're going to have 40 years of something. Whether you have all your money in bonds or all your money in stocks or some combination, most people have some combination when they're older. And for some people, they're going to, who's starting at age 25 to invest, they could be 40 years in equities. Maybe not all equities all the time, but certainly the first 30 years, they could be all equities. Now, let's look at the average 40-year return. There are 57 40-year periods between 1928 and 2023. The compound rate of return for the S&P 500, 11%. For large cap value, 13.4. So these are two indexes or asset classes that are large companies. One is a blend of growth and value. The other is all value. And what we see is that the best 40-year period for the S&P 500 was 12.5% compound rate of return, and the worst was 8.9. So this is why when people in the industry say that bonds are safer for the short term, but stocks are safer for the long term, to the extent that we really need to build and make money with our money, and remembering that what we own to do that are some of the greatest businesses ever in the world, along with Enron, along with Washington Mutual, along with Eastern Airlines. I don't want to pretend that there aren't dogs and people that will hurt you, stocks, I should say. But here's what we know. That yes, the range 12.5 to 8.9, with large cap value 15.6 to 8.8, with small cap blend 16.7 to 10.6, and with small cap value 19 and 11.6. Boy, those are great returns. And here's the problem: you can't buy them. You can't have them. You can't count on them because nobody knows. I think about where the world was 40 years ago and what we've been through and the new products that have been developed. And as the new products were developed, the people it put out of business at the same time as it became viable. A time when the automobile companies were, as the old saying, as goes GM, so goes the country. Well, fortunately, the country didn't go bankrupt, but GM did. Sears Roebuck, when I came into the industry in the mid-60s, Sears Roebuck was considered to be the company you could go to work, you could be a janitor at Sears Roebuck and expect, because you would get shares of stock over the years, to retire a millionaire. No, it didn't work out that way. Now, had you invested in the S&P 500, it would have worked out that way. I mean, that's the interesting thing, is that the safer way, the more diversified way, has paid the premium with virtually no risk of being deep sixed with losses because you put all your money in Enron. And the problem is, remember I talked about the problem with people selling, and then the difference between the courtship and the honeymoon in reality. Well, the courtship at Enron, this is true. The people in the company, the officers, were telling the employees, yes, they should put all of their 401k into Enron stock. That was the courtship. And at one point, the honeymoon was wonderful until, in fact, the honeymoon was so good that it made it very obvious. You didn't even have to tell them to buy it anymore because they'd been buying it and they'd been making money. But the reality came. The reality was people got wiped out because they were oversold, because they didn't know to ask the right questions about risk. And these numbers that you see are the lowest risk way that I know for you to get a good return. Now, I also know that at the beginning of this long period of time, nobody knew the idea of a small cap company. They didn't know what a small cap value company was. Those kinds of understandings didn't come along until basically the 90s. That's the 1990s. And I might mention in 1924, investors did not believe in putting money into the stock market. They thought that was absolutely nothing more than a speculation, and the good place to put money was in bonds. That's what they believed. And then, of course, the Depression came, and a lot of people continued to believe that because the Depression taught them an interesting lesson that you lose money in the stock market. And my lesson is I guarantee if you invest in the stock market, you will lose money along the way, guaranteed. But if you diversify and you're careful, if you want to be conservative, just use the S&P 500. There is nothing wrong with the S&P 500. I would be trying to talk young people into expanding. I mean, it's like, it's okay if you got more money than you need to put all your money in short-term bonds. And it's not evil. It's not a con job. It's just a very low risk thing to do. And I would be trying to encourage, and you'll see some of this as we go along, to take some of that money out of bonds and put some of that money in equities. You're going to see what happens when you do that. And even if you don't have the risk tolerance for a lot of stocks, even 10 or 20 or 30% can be a game changer. You'll see that if you stick around. So I'm not trying to say that small cap value is going to make 16.1% in the average 40-year period. I actually believe that probably for the S&P 500, 9 to 10 is legitimate. I believe large cap value is 10 to 11. I believe small cap blend is 11 to 12. And I believe small cap value is 12 and above. But it may take more than a few years for that to happen. But now, very briefly, I want to take you into the right side of this table. Because on the right side of this table, we have the implications of combining these four equity asset classes. Now, I am going to dig much deeper into this kind of analysis when we go into later, when we go into the ultimate buy and hold strategy and into the sound investing portfolios. I'm going to show you all sorts of information about risk and return of combining these and even some other equity asset classes. But just at the very basic level, I want you to notice that whether you took all four of these equity asset classes and you put 25% in each, notice the average compound rate of return was 13.7. Now remember, value did better than growth historically over long periods of time. But I want you to notice if you got rid of the small blend and you got rid of the S&P 500, the large cap blend, and only had a portfolio of those two asset classes, the compound rate of return average was 14.9. Again, I'm not dangling that number, suggesting that's what it's going to be. I'm only saying that I believe if you combine these asset classes, you can have more diversification. And you're going to see years when the S&P 500 is a dog. And these other asset classes are doing just fine. And then you'll see times that the S&P 500 is blowing them away. And so this is how the market works. And nobody knows when all those changes are coming. Finally, a strategy that I just think is a wonderful strategy, because the two-fund strategy with the S&P 500 and the small cap value, so that you only have two funds you got to worry about for the rest of your life in the equities part of your portfolio. The two being the S&P 500 and small cap value. It gives you value large. It gives you value small. It gives you value small companies, and it gives you large companies. And the compound rate of return is virtually the same as the four-fund strategy. So the reason for this presentation is that I want you to believe long term that it's okay to take the risk of equities. But if you are going to focus on the short term, it is going to be very, very uncomfortable because it's going to scare you. You're going to feel when the market is going down, as it did, for example, for the S&P 500, from 2000 through 2009, it lost about 1% a year for 10 years. In fact, it lost more over that 10 years than it did from 1929 to 1938. And twice during that 10 years, it lost over 50% of its value. And the other asset classes, chugging right along. But prior to that, the S&P 500 was just wiping them out and performing brilliantly to where you wish I had all my money in the S&P 500, for crying out loud. It's so easy. They're companies whose names I know, and I don't know the names of the little companies. I would have felt so much more comfortable. But the bottom line is, in terms of what we're trying to provide, is not information on how to have fun as an investor. My wife and I do not have one penny invested for fun. We are focused on trying to do well with our investments because we have people who we know, charities and children who would like to benefit for our patience and our good decisions. So we're willing to take some risk, but we don't do it for fun. We find the fun elsewhere in our life where we sense we have maybe more to do with the outcome. The thing that investors need to understand is what you believe has very little to do with what the market does. I know about what I'm thinking, how I may interpret what's going on today, politically, economically, on a worldwide basis. The things I look at, there's always list A, the good news. There's always list B, the bad news. I got my good list. I got my bad list. I know how I feel. The world does not care about how I feel. And that's confusing to a lot of people because we like to figure things out and come to conclusions about what's going to happen because we figured it out. Well, this approach to investing that I'm going to show you over the coming weeks is not about figuring out anything except what asset classes have a history of paying a premium for taking the risk. How bad do they perform when they're out of sync with my expectations on the downside? And yet my expectations are there will be downsides. And I think I understand what those are like. I'm going to take you much deeper into understanding the downside as we move forward, because you're going to know not only what the worst year was, you're going to know the worst 12 months in a row. You're going to know the worst 6 months, the worst 3 months. You're going to know about the worst 3 years. You're going to know about the worst 5 years. You're going to want to know about the worst decline, regardless of time. It's called a drawdown from the peak to the bottom before it goes back up. You're going to understand as much about how this investment process works as any professional investment advisor. They can't know any more than you're about to know from this series. And by the way, this is not that I'm great. It's just that it is the fact that there's only so much you can know, and there are just a handful of things that we know historically drive your return. And a lot of it is if you have the patience to let it happen. And what we want is to give you the information that when the bad things happen, so we all like the good stuff, that we have no problem dealing with the good times. It is the bad times that we have to deal with. And you said, I want to be a do-it-yourself investor. I don't want to pay somebody 1% to take care of this. I want to keep that 1% in my family. Great. Now let's just make sure that you understand what the people who get that 1% need to know to get it for you. Because that's our goal, is to show you how to get it. Now, we're going to add this recording, this video, to our page about stocks versus bonds. And right now we have an article there, and we have these tables there, and we add the video. And then as I go through these different topics, like fine-tuning your asset allocation, how much in stocks and how much in bonds, and how to build these portfolios, and how to take money out in retirement, and how to put money in, every time we're going to have an article, a podcast, and a video. So you can explore it 3 ways. And of course, the tables of numbers. But then you have questions. And so what we'd like to do as we move forward is on each of these pages, we're going to have a Q&A section. And you're going to email either, when it's my stuff, paul@paulmerriman.com. And you can email Chris on his stuff, and there'll be a link there where you'll be able to email him. And when you have questions for Daryl, there'll be a link there. But what we're going to do is we're going to put those Q&As on the website, on the page that it applies to. So you'll be able to come if at the end of 3 or 4 months, you want to go back and see what kind of questions people asked about stocks versus bonds, this might help you. Because what we are trying to do, again, help do-it-yourself investors do it better for a lifetime, and help their children, and help their grandchildren. That's the goal of our foundation. And I hope that we are successful for you. Thanks for watching.